Good afternoon, everyone. I hope you had a great lunch. The topic of my presentation is called Cooperating in the Age of New Normal. New normal, I'll define it during my presentation, what we call new normal. I was in the hotel room last night, and we have a lot of things in the environment going on, lots of things. And I had the chance to look at the 7th goal of the Maple Leafs against the Lightning. And so we see things that are unprecedented in the economy, and so I felt like it really is a new normal happening, really. So I was able to add that. And cooperating is because I think looking at where the Montreal Canadiens are standing, I think that we'll be willing to cooperate to trade some players with you guys, especially Philip Kessel. So again, good afternoon. Thanks, Greg Pollock. I would like to thank you. Thank the Advocis organization. It's really an honor for me to be with you today. So I'm going to begin by reading you a quote. And the quote goes like this. It is increasingly clear that the current downturn is fundamentally different from recession of recent decades. We are experiencing not merely another turn of the business cycle, but the restructuring of the economic order. Executives preparing their organizations to succeed in the new normal must focus on what has changed and what remains basically the same for their customers, companies, and industries. This result will be an environment that, while different from the past, is no less rich in possibilities for those who are prepared. That happy quote is from McKinsey Quarterly of March 2009. And the bittersweet message that it delivers says a lot, both about how we got there and where we're going to be in the future. There has been a lot of debate since the financial crisis about this concept of new normal. Have things really changed so dramatically? Or is it just a blip on the screen and we'll go back to the good old days in no time at all? Many have argued that the new normal is a myth. Others agree with McKinsey that there's no going back. Who's right? And what does it mean for our clients, our advisors, and even our employees? Before I answer that question, let's look back at what happened since the original credit crisis of 2008. Since those dark days 3.5 years ago, we've seen Wall Street and the global financial system bailed out by governments around the world. They have taken strides in returning their balance sheets to the health, and in some cases back to profitability. We also saw a return of big bonus and big leverage. So it seems back to normal, right? Crisis averted. But something funny happened on the road back to the good old days. Massive public sector debt, prolonged recessions, and slipping interest rates have forced countries like Iceland, Ireland, Greece, and now Italy to the brink of default. Other big debtors, nations like the UK and Japan, have imposed belt-tightening measures, austerity measures, that have forced the pain onto their citizens. That, in turn, forced the people onto the streets in protest. And that protest has spawned a movement, Occupy Wall Street, which has gone global. Meanwhile, the U.S. has flirted with default in its debt ceiling showdown last summer and has more recently taken the unprecedented step of announcing that it will keep its benchmark interest rates at historical low. They call this one Operation Twist. It will certainly force us to dance in the environment in the years to come. I will leave it to you to be the judge whether this new normal is something permanent, a kind of guaranteed uncertainty, as they refer to at LIMRA. But whether it is permanent, a simple bump in the road, or something in between, the result of this has definite implications for our industry, both from a manufacturer and distributor point of view. And that is really what I want to talk to you about today. In the context of this new normal, what does it mean for our industry? And also, what does it mean specifically for distributors of insurance and savings products? I also want to discuss why Desjardins Financial Security, or DFS, has a unique perspective on these issues as part of the Desjardins Group. Before I conclude, I will look ahead to some future trends that will affect our industry, and I will end with some final thoughts. Okay, let's begin now because we have quite a bit to cover. Maybe the most important and far-reaching consequence of the new normal for the global economy is the reaction of government as they speak to contain and control future crises through regulation. Since 2008, hundreds of task forces and parliamentary commissions have written countless white papers and made thousands of recommendations, most with the well-intentioned goal of controlling risk-taking in financial products and services. In a perfect world, prudent and responsible companies and industries should have nothing to fear from well-considered regulations. However, in these politically charged times, regulation can become a race to the bottom, or worse still, a witch hunt. As you know, part of the reason that the Canadian financial system weathered the storm better than many of our G20 partners was the prudence of our financial institutions and regulations. However, we are not immune from the global desire to create international standards. Some of these, particularly the move to IFRS, International Financial Reporting Standards, and new capital reserve rules, present insurance companies with unique challenges. Clearly, the new normal will have significant impact on the way insurers design and price their products. This issue has not escaped the notice of regulators. In fact, earlier this month, Julie Dixon, head of the OSFI, or Office of Superintendent of Financial Institutions Canada, publicly challenged the industry to respond to what she described as a game changer. She said, if low interest rates continue, as many expect they will, they are a game changer. Even if they do not stay the current low levels, recent experience has once again driven home to the point that life insurance companies must not forget the long-term nature of the contracts they write. Mrs. Dixon acknowledged that many of us are being proactive in re-examining our product strategy and factoring in the long-term risk of guaranteed products. She views this as a possible renaissance for traditional product offerings, with very low interest rates and conservative mortality, lapse, and expense assumptions. She could be onto something there. However, Mrs. Dixon warned that some of us may not be moving quickly enough to recognize that a change in strategy is also required. Life insurers need to start making changes to their product portfolio today to mitigate the grading of these low interest rates into the ultimate reinvestment rate to value long-term liabilities. Like any serious life insurer serving the Canadian market, our goal is to strike the appropriate balance between realistic assumption and competitive pricing. This year, like most of our competitors, we reviewed our permanent portfolio and repriced accordingly to less optimistic market conditions. We have and we will continue to balance the needs of our distributors to have innovative and competitively priced products, while at the same time staying true to our culture of prudent risk management. Mrs. Dixon also suggests that an insurer can learn from Canadian banks that have already experienced this game change. One advantage for Desjardins is that our operations are very similar to those of the large banks. We've learned a lesson. The new normal also means a new breed of customer with very different expectations regarding products and how they are serviced. One area that is facing a renewed scrutiny from regulators, and that is one of great interest of today's audience, I'm sure, is the question of the MGA oversight. Namely, whose responsibility is to ensure that this channel complies with the statutory requirements of the industry. The evolution of the MGA channel over the past several decades has clearly been of great benefit to the industry, and speaking for DFS, an excellent source of new and important market. At the same time, we must acknowledge that the independent nature of the MGAs and their interconnecting web of associations make their relationship to the manufacturer more complex and more difficult to understand. The current regulatory environment relies on the terms of the individual contract that the manufacturer has with each of its MGAs. Because there's no formal legislated definition of an MGA, the terms of these contracts can vary widely, both from manufacturer to manufacturer and even from MGA to MGA within the same manufacturer. Though this can be complex to manage, it does have the advantage of providing flexibility for insurers to establish relationships with MGAs that capitalize on their various strengths. This is an issue that is evolving as we speak. I think you've had a glimpse of that this morning. We are keeping a close eye on it and evaluating developments through all of the channels available to us, including direct consultations from the regulator, in this case CCRI. We also recognize that any move to clamp down could prove difficult for our MGA partners. In that light, we are committed to being proactive in preparing our distributors for the new reality, whatever that turns out to be. Before I turn to look at accounting changes, I want to read a section from the CLHIA submission to CCRI regarding MGA regulation. There is no question that the lack of specific rules has made it possible for a number of different business models to develop within the MGA channel. But rather than characterize the situation as a lack of rules, it is more appropriate to point to the principle-based nature of insurance regulation and its inherent flexibility. It is arguably a strength of this approach that it can support diversity and allow the industry to find ways to promote efficiencies while providing a desired level of consumer protection. This is a position that DFS fully supports. As I'm sure you know by now, publicly traded companies in Canada must begin reporting results according to the accounting rules of the IFRS. The change is mandatory for fiscal years beginning this year, actually. With the last of the fiscals beginning earlier this month, we all now on the new IFRS standard. This is a tremendously complicated change, and I won't tax your patience by trying to explain the difference between IFRS and GAAP, or generally accepted accounting principle. But the heart of the matter is that most public companies that switch from GAAP to IFRS are likely to show much greater volatility in their financial results. Of more pressing concern for most insurers is impact these changes will have on permanent life and health products. As I mentioned earlier, we have already seen significant repricing across the industry. This looked like it will be the new normal for permanent products, and any types of products offering long-term guarantees, by the way. In addition, segregated funds will now have to be included as assets in the balance sheet, dramatically increasing the insurer's reported assets under management. The rationale is that the insurance provision that underlies the seg fund contracts makes it both an asset and a liability. The transition to IFRS will certainly impact group retirement plans, possibly leading to some transition away, once and for all, from defined benefit programs to defined contribution or single premium plans. Also, the new rules will undoubtedly mean that any guaranteed benefits will be less generous. Again, this is a situation that is unfolding in real time, but we are working through it to ensure fairness for both the industry and consumers. One thing I can tell you is that we are going to be proactive on this because we feel that organizations who adapt and innovate to this new environment the fastest will gain an advantage over the marketplace. While the accounting rule changes are something of an internal issue for manufacturer and their finance department, the new capital reserve requirements have the potential to impact our products and our profitability deeply. We agree with CLHIA when they stated on behalf of 21 other national industry associations at last year's J20 conference in Toronto that the insurance industry is generally supportive of having strong prudential regulatory standards that are consistent with a risk-based approach. We would urge regulators at the national and international level to be mindful of the effect that excessive capital requirements might have on insurers, as well as their abilities to meet the needs of our policyholders. In fact, our CEO, Monique Leroux, spoke at the United Nations this month and called on international regulators to think long and hard about what qualifies as capital when designing new rules. She also urged them to recognize the various needs and abilities of different business models. Of less immediate concern, but with the potential to have greater, longer-lasting implications, is the effect of the new normal consumer for the industry. For the post-crisis consumer, it is all about earning back their trust and providing alternative ways to serve and satisfy them. At DFS, we are very fortunate to have the strength of the Desjardins brand behind us and all of the strength, security, and stability it brings, all key for consumers. This new consumer is also looking for flexibility and liquidity, the ability to pick and choose what she wants, not what a company wants for her. Again, in this we are fortunate that our position as part of the Desjardins Group gives us the potential to deploy a number of complementary financial products and services that not only a diversified full financial service offer can bring to the table. This greatly enhances our value proposition, and I want to discuss this more when I'll talk specifically about the Desjardins model. I'll also talk more about this new normal consumer when I look at the implications for distributors. I don't think it will come to you as a surprise that our distribution channels are facing many of the same challenges that the insurance companies like DFS are facing, including for MGA's greater scrutiny from regulators, the evolution of the client relationship, and lastly, the effect of demographic changes for advisors themselves. With respect to regulation, as I discussed earlier, the MGA channel is gaining the attention of regulators, especially in the area of compliance management and advisor training. It should be said that when it comes to compliance, for the most part, the buck stops with the manufacturer. Federal insurance regulations require us to design and deploy systems for risk management and compliance, while the various provincial insurance regulators mandate many other responsibilities to the manufacturers. Believe me, it takes a small army to manage this complexity. When we enter into a distribution contract with an MGA, we may choose to delegate compliance and other administrative functions to them. However, even if we delegate those tasks, the overall responsibility remains with us. It is our duty to ensure that these functions are done right. This is a core skill for us, and we are committed to helping our distributors build this capacity. You know, it would be easy during these troubled times to turn inward and focus on ourselves, but that would come at the expense of our most important relationship, our relationship with the customer. Indeed, managing their expectations and fear is more important today than it has ever been before. There is no shortage of advice for advisors out there for how to manage client communications in the new normal, and some of that advice is actually pretty good. I'm a firm believer in the principle that more communication is better. This is not the time to shy away. It is a time for openness and transparency. It is an opportunity to demonstrate the value of good advice. I know that you're going to hear a whole lot about this in the next session, so I won't go into a lot of detail at this point in time. What I will say is that clients don't want you to be just an order taker. They want to work with someone who adds value to their lives, anticipate their needs, and offer them customized solution. In the age of social media and social content, one size does not fit all. This is a message that we have taken to heart in the marketing communication we produce at DFS. We are focused on building tools to empower advisors and help them better pinpoint and address fears around financial security. We are also committed to helping them effectively target important market segments and engage these important new customers in a meaningful dialogue. We can never assume that we know what we know out there or what we worked in the past days will work today. As Canadian population changes, so does the advisor base. Research from investment executive indicates that the average age of Canadian advisors is almost 50 years old today. Sorry if this offends anyone, but as an average, it's pretty high. A good thing is that people in this room look a lot younger. Around 2005, Around 2005, firms began to worry that they were facing a potential shortage of advisors and sales representatives, as a large number of them approached retirement age. However, it turns out that they had a different problem altogether. It seems that the traditional retirement age really means nothing to advisors. There are several reasons for that. Mainly, retirement doesn't carry the same significance to them. Because of the flexible nature of their work, many advisors will not fully retire and plan to go on working well into their 70s and to their 80s. DFS answers to this dilemma shouldn't come as a surprise to anyone here. It comes in the form of our rock-solid commitment to our career network known as Desjardins Financial Security Independent Network, currently called DFSIN, and Desjardins Financial Security Investments, DFSI. I talked a lot today about the MGA channel, and it is true that a lot of the growth for the industry has come from there. However, according to LIMRA, the share of business coming from the career channels has held steady at around 30% since 2007. In fact, during that time, annualized premium growth from the career channel was 20% versus overall growth of around 15%. For manufacturers with career networks, those numbers are even bigger. In 2010, we recruited more than 300 new representatives into our networks across Canada, and even more this year. DFSIN has also pursued its strategy to regularly open new financial centers and to recruit in order to reinforce our existing team. This is one of our highest priorities, and this is a key factor we look at when we measure our success. The ability to retain representatives over the long term is a priority. We do this by offering competitive and distinctive advantages. Of course, our unique business model is attractive, but we also make sure to support our representatives' careers from the beginning till the end. It is a huge commitment of time and resources for us to recruit, train, and maintain a full-service channel, but it is also a show of trust in these people because they carry the Desjardins name with them and represent our organization within their community. Perhaps nothing else we do demonstrates our commitment more strongly. I've spoken at some length already about the state of the global economy and the implications for the different aspects of our industry. I hope I haven't depressed you too much. This is not my purpose, and certainly not the attitude we have at Desjardins and DFS in particular. Quite the contrary. Our mission is both hopeful and pragmatic to contribute to improving the economic and social well-being of people and communities within the scope of our business activity. We strongly believe that education and cooperation with a healthy dose of entrepreneurial spirit are the drivers for sustainable prosperity. One of our founding values is to put money at the service of human development. I guess you are starting to see that we are not your average financial services company. It's true, and we believe that our approach is well suited for the success in the new normal. As you may know, 2012 is the International Year of the Cooperative Movement, and the timing could not be better. Desjardins is hosting the World Summit in October to shine a light on this alternative way of doing business. Over 125 speakers from around the world are expected to visit Quebec City and Lévis, our hometown, and a lot of innovative thinking will take shape. This is an issue very near and clear to the heart of our CEO and to the spirit of the organization. Indeed, as I mentioned, Mrs. Leroux recently met with officials at the UN, where she predicted that the World Summit would put us on the world map. When we talk about cooperation at Desjardins, we mean working together to achieve prosperity for our clients and our communities, rather than merely for shareholder enrichment. In practice, this means having a social conscience as a company and making a big commitment to socially responsible behavior. For us, this is a core corporate value and one of the most time-honored founding values. For us, it is not about PR or employee relations. It is on our DNA and one of our most valued business outcomes. Every year, Desjardins proves its commitment to Canadians by investing millions of dollars in local communities across the country. This year alone, we will have invested $80 million in many key initiatives, foundations, and celebrations. From artistic to sporting organization to cultural community events and numerous causes and partnerships, DFS and the Desjardins Group supports our communities. In addition to some large national sponsorships, DFS took part in more local events. For example, we joined the local Punjabi communities in Vancouver and Surrey, BC, to celebrate the Vasikhi Cultural Festival, while in Halifax we supported the emerging Atlantic Film Festival. We look forward to participating in even more of these events next year and the years to come. I also mentioned education when I told you about our mission, and I would like to talk more about that specifically at DFS. Involvement in the national financial literacy movement is an important priority that we share with Advocis. And it's the big reason why, year after year, we remain a proud, significant, and committed sponsor of the Advocis schools. A prosperous society must be supported by educated and informed individuals who have the desire to learn and who have the tools to master their future, financial and otherwise. Education, specifically financial, economic, and democratic education, is a necessity not only for young people, but for all of us. It enables people to manage their assets responsibly, avoid excessive debt, and make informed decisions about the many financial products and investment vehicles on the market today. It also makes it possible for people to contribute to the future of their society through democracy. In addition, we want the financial experts who represent Desjardins brand in their community to be skilled and effective communicators. I'd like to give you an example of how we are showing our commitment to greater financial literacy. DFS is working with local community colleges to establish awards of excellence for outstanding students studying insurance and wealth management. In particular, our work with nearby Seneca College involves commitment from both the manufacturer and our distribution partners in our career network. We believe that this kind of holistic or grassroots approach to education will have the greatest impact on the financial literacy of our communities. As I mentioned earlier, as part of the Desjardins Group, DFS is uniquely positioned to leverage our array of financial services and products to expand the portfolio of financial planning and management tools available to our distributors. There are a number of senior-level discussions taking place at the moment as to how best make our unrivaled offerings in the area of consumer credit, travel insurance, retail banking make it available to our DFS networks. This is a very exciting initiative, and I expect you will be hearing more about this in the near future. This is the point of my talk where they asked me to put on my crystal ball and put on my wizard's hat. Wizard's hat. Let's not mistake here. But since Halloween is 3 weeks ago, I think I'll pass on that. Seriously, I understand that everyone wants to know what the future holds and where the industry is going in the next 3, 5, and even 10 years. I want to know too. Again, there is no shortage of studies and scholarly articles out there claiming to know what lies ahead for our industry. Both LIMRA and PricewaterhouseCoopers have released quality studies this year that tackle the challenging road ahead. I encourage you to read them and make up your own minds. I will give you a word of warning, though. They are not exactly optimistic. To give you an example, the PricewaterhouseCoopers study report concludes with the following thought. While it is unclear how these global scenarios may play out and impact the insurance industry, it is clear that there will be significant changes for insurers regardless of what happens. In the course of my talk today, I have already alluded to the number of things that I think we can expect in the coming years. And it will have a lot to do with external factors that we cannot control. But even though we can't control them, we can certainly plan for them and look for the opportunities ahead of us. That is what we are doing, and I'll share a couple of them with you now. What we see happening will be the particular challenge for distributors. There are two different but related trends that we believe will come to dominate the agenda for wealth managers. They are the twin challenges of the exit strategy and the barrier to entry. The exit strategy concerns retirement income and what we see as the growing gap between the client's needs for adequately plan for and fund longer and longer payout period. The strength of our advisors in the accumulation period helping build wealth. However, the assumptions that were used to calculate retirement needs may no longer apply. This is already an issue, but if even the most optimistic projections for the new normal economy are true, this has the potential to become a very big problem for Canadians. We are working to develop a robust tools that will help our distributors better assess clients' needs for retirement income and recommend personalized solutions. The barrier to entry is the very worrying issue of the outsized customer depth of those in the accumulation phase. Simply put, the next generation of accumulators do not have enough disposable income to fund for their retirement. There has been a trend towards deleveraging in the rich world, but it has lost momentum recently, and the average Canadian household debt is still alarmingly large. Better financial literacy will help, but it won't solve this problem on its own. For advisors, helping this next generation will require new skills and new tools, and will be there to help. Another trend to keep an eye on for both manufacturer and independent distributors is M&A activity. One consequence of the economic new normal is that a lot of cash is sitting on the sidelines. At the same time, LIMRA recently confirmed that what we already know. The cost of earning new premium dollars is getting more and more expensive. The market is ripe for consolidation. DFS announced 2 significant strategic acquisitions in 2011. Both Western Financial Group and MGI Financial were bought into the group this year to enhance our value proposition. And I think this is a trend you can expect to see continue and intensify across the industry. I've already mentioned it a few times, but the next generation of consumers now coming of age will drive change in the way we communicate and the platforms we use with them. However, I have some good news. While communications and technology will continue to evolve and require us to adopt new ways of doing and seeing things, I strongly believe that it won't replace the value of good human advice anytime soon. I would add that this goes for health insurance and savings products as well. Now, some final thoughts. So no big surprise at all. The future is uncertain. I think you don't need me to tell you that. If you read the news on any given day, you might wonder if we'll ever see the sun again. A few weeks ago, 3 of our biggest rivals announced huge quarterly losses. Certainly, it shook their shareholders somewhat and caused a bit of a ripple effect on the markets. But guess what? The sun came up the next day, and those companies are still there, a bit bruised, but still competing with us. I can tell you that our industry is healthy. Our organizations are world-class, strong, and well-managed. The future is still bright if we adapt to the new normal. Speaking of reading papers, I came across something interesting recently that I'd like to share with you. And the quote goes like this. More than ever before, it says, people are struggling on the economic battlefield. Now that communications are easier and more rapid, the market has become a world market, and the definite victory will go to the country that has succeeded in marshalling all of its energies and the vital forces of its citizens, that has succeeded best in supporting their initiatives, and that, as a consequence, has adopted the most productive plan with the least effort. It sounds like this quote was written yesterday, right? Well, actually, these are the words of our funders, and he mentioned that in 1910, so 100 years ago. So over 100 years have passed since then, and we have seen the greatest expansion of global prosperity in the history of mankind. The uncertainty and volatility of the last few years have been difficult for many, but it is also a very exciting moment, full of opportunity for those who can accept and embrace the new normal. I'd like to thank you. Thanks the organization again for giving me the time. Absolutely.
We have time for a few questions.
If you have a question,
please go to the mic and address your question to Denis.
Monsieur Berthiaume, merci beaucoup. I have two questions for you. One relates to our confrères in the banking business, one of which in particular has introduced a product that has a lifetime guarantee of interest. I'd be interested in knowing how that would be reserved in the banking sector. The second question relates to an opportunity perhaps for us in the life insurance business to provide some of the solution to the increasing cost of healthcare in Canada. Thank you.
Okay. I want to make sure that I captured your question well. Okay, so the first one relates to the fact that you have a banking institution giving a lifetime interest rate or guarantee. Okay. I believe there's a lot of discussions at this point in time around this issue, so I'm not necessarily in a position to comment on what the regulator or how actually it will be, the accounting rules will be adjusted or all the discussions. So I'm not really in a position to answer the first part of your question. And the second part, can you just the second part of your question?
We know that Canada faces an ever-increasing cost of healthcare.
Yes.
We know that Canadians rank healthcare as second only to the maple leaf as a definition of Canada. Or, excuse me, a maple leaf from a Quebec forest. And we know that the provinces face something that will soon approach 50% of their budgets. Mm-hmm. We know that they look to the federal taxpayer, who happens to be the provincial taxpayer as well, to finance this. And so governments are looking at ways to limit the rate of increase. One way in which some of the costs can be shared is through insurance products. We provide, through group plans, a good deal of the coverage of prescription drug plans in Canada, which itself is a large portion of healthcare costs. Are there opportunities beyond that that we might be able to provide in the future?
Okay. So going back to your first part of your question, I can't comment. In terms of, I think that it is being looked at, so how it will unfold is unclear to me. So this I cannot answer. Second part of your question, I believe that the biggest challenge we have on the healthcare side is that we are always second payer. We kind of complement what our governments are deciding to provide to their citizens. And there's a lot of, let's say, lack of clarity from their side, because, it's really not specific there. I don't think they're sending strong signals of what their intention, about what their real intentions are. What we know is we look at it from a financial standpoint, as they do, and we say that something with the aging of the population, we know they're on a crash course somehow. This we know, okay? Our difficulty, I think, is to define how we will actually adjust our offering, because we're kind of dependent on how they will position themselves, okay? At one point, the insurers launch products like long-term care, for example, long-term care products. One of the key challenges we have with such a product is actually what is the government coverage, and what, so it's kind of a complement. So we always have a complementary approach to what the governments are doing. So it's kind of difficult for us to provide a service offer that when the government is unclear. So I think that the key point will be through dialogue with the government. And sometimes we are approached, as institutions, we are approached by the government to look at solutions. At times of private products we could offer, this happens. What we really don't know is when, okay, in terms of when the government will actually make these difficult choices. Because the population is expecting the government to play a role. Everybody wants to have full service and pay less and less, in terms of taxes. So that's the situation we're facing now.
Thank you.
But clearly there are opportunities, absolutely.
I wonder if you could comment on your perspective from inside of your company, how you're addressing what I would describe as the marginalization of the small client, with the increasing fixed overhead costs, in particularly ones that are either direct regulatory or related to regulatory compliance. I know my company and most others that I'm aware of are increasingly telling their advisors, please don't talk to these people because we can't afford to service them. And I wonder if you have any comments from your large organization as to what you see happening in that area.
It is a very good question in the sense that it is an important element. You know, when we look at the situation, clearly with the increasing cost of advice, increasing cost of compliance, increasing cost of many things in terms of fixed costs, what do we do with small customers, or what we call mass customers? How do we approach them? What is the most effective way to actually service them? And I think our only answer can be more web, more electronic, more automatic servicing approaches. Personally, I think that the value advice is kind of moving upscale, you know, in terms of the capacity to advisor or customers to pay for complete advice. It is a challenge. So I think really the solution is to have simple products that are easy to distribute, that actually people could buy online or could, you know, facilitate the transaction to the maximum, making it as efficient as possible. That's, in my sense, that's really the only approach that we can follow.
Any more questions?
Good. Thank you. Thanks again.